Welcome back everyone to the Money Control live stream. You're watching markets with Santo and CJ in association with M Stock by Mirae Asset. Well, the bulls have had the day. They have made a very strong comeback along with the global upswing that we are seeing in risk appetite at this point of time. If you look at the Nifty and Sensex, both surged over 2%. We had a mild start to the day, but clearly the momentum picked up throughout the day, and that will make a lot of investors happy. The small cap and mid cap space, which saw a lot of liquidation yesterday. I mean, they were the ones who had taken the beating yesterday. They also have rallied today, rising with the mid cap and small cap indices rising more than 2% each. The fear gauge India VIX fell about 4%, clearly indicating that there was a lot of short covering in the market. Santo, even a brief outage in Zerodha, Upstocks and all the other online brokerages could not stop the day for the bulls. I mean, clearly the bulls have had the day and they've forced the bears to cover their shorts.
Well, some kind of a pullback was on the card, CJ, considering that market had fallen so much over the last few days. So this was pretty much on expected lines. But then I think investors should see this rally for what it is. It's just a temporary pullback. Nothing more than that.
Oh, come on, Santo. Maybe this is the beginning. Maybe this is the start. You always cannot tell when it is a beginning. You always keep on guessing.
I agree with you.
Whether it is with respect to a top or whether it's with respect to a bottom.
Market never rings a bell, as they say. But
exactly.
CJ, I would go by probabilities, and at this point, if I were to look at purely on the basis of probability, then the probability of this being the start of a, or the resumption of the bull market seems pretty low to be. It's evident from the way in which you saw the kind of retail selling yesterday in mid caps. Very little FI selling yesterday, barely about 1200 odd crore. But look at the way in which the broader market
apparently there
yesterday.
was a lot of margin calls made on the retail investors in the smaller mid cap space. Not only retail, even HNI clients of a lot of brokerages probably face the margin call. That is the news coming out. If you speak to brokers and dealers out there. So clearly yesterday was that day of capitulation that the market was waiting for. And maybe today we are seeing a little bit of relief coming on.
Yeah, I think, but CJ, this relief rally then should be used to exit the junk stocks. I think a lot of people would have bought, stocks at random because the market as a whole was going up. But now that the party has stopped for the time being, one should, bite the bullet, I would say, take a hard look at the portfolio, because not all stocks are going to give the same kind of returns as they would have in the last couple of years. Take some tough decisions and, discard some of the junk stocks in the portfolios.
Whatever you do, I think, Santo, maybe a new party is on the offering at this point of time, although it's just Tuesday. But yeah, clearly there are some good signs out there for the bull. But having said that, individually a lot of stocks were in action today. You look across the board, there was only green to see today, and you have some stocks, Santo, that you want to talk about.
Starting with Mahindra and Mahindra. CJ, now this is the time to, I've been saying this for the last couple of weeks, and I'll continue to maintain the stand that this is the time to approach a safety first strategy, and it makes sense sticking to some of the tried and tested name, Mahindra and Mahindra. The stock has been a clear outperformer in the auto sector. So the positive,
I have to give that to you. Yes.
The things going in favor of the company at this point. It's been improving its market share in the bread and butter SUV segment. It made a strong comeback since the second half of last year, and it continues to extend that good show. Even the May numbers were quite strong. Even after factoring in for the low base effect, and if you were to compare it with the May of 2019. The numbers are pretty decent. The growth is pretty decent. Now, tractors seem to be a bit iffy now that the monsoon is getting delayed. Till I think a couple of weeks back, it was both SUV as well as tractors, which was the main story. But even, setting that aside, you would think that the stock is showing good strength on the charts also. It's very close to its 52-week highs, and it's among the few stocks which are right now trading close to its 52-week highs, and this stock seems set for a further round of outperformance.
Well, Santo, I have to give it to you that yes, the performance so far has been quite good, especially you look at the sort of optimism that the market is baking in with respect to the passenger vehicle side of the business, but tractor is accounts for almost 45% of the company's EBITDA. Clearly, that is one segment that the company cannot do without, and the outlook there is starting to look a little patchy for me. We know that the monsoon has been delayed. I mean, just a week ago, the deficit in rainfall was more than 38% across the country, although that has narrowed over the past week, but clearly the monsoon is still running in deficit compared to the past 2 years. So that should be a worry that, it could put the rural demand story, the recovery in rural demand story at risk going ahead. Apart from that, if you look at some of the data coming out of the government, the Kharif season sowing also, Santo, has actually seen a decline from previous years. So that also worries me whether we will see that, the rural demand recovery that everybody has been talking about with respect to two-wheelers, with respect to tractors, with respect to FMCG companies, whether maybe that narrative also could be falling apart at this point of time. So those two risks, keeping that in mind, I just feel that the upside for M&M going ahead could be limited, because let's not forget it's the second best performing stock in the Nifty this year, probably after Coal India. So clearly a lot of positives have been baked in. So maybe going long on the stock at this point of time may not be the the most wisest choice.
But well, there are not too many stocks to choose. Good stocks.
I'll tell you a good stock, Santo.
Sure, please.
Yeah, I'll tell you a good stock. I mean, you want to be safety first, but I'll tell you a stock where you can actually take a good measured risk, and that is Nazara Tech. Clearly, this is one stock that has taken it on the chin, just like a lot of other technology stocks out there, down almost 50-60%, maybe even more than that from its record highs last year. Now, the stock has surged today in action, clearly largely because of a little bit of short covering, but also because some buying interest is also coming in from HNIs, according to dealer. There was a big block deal on the stock today with almost 0.3% of equity changing hand, and these sort of big deals are usually done by either institutional investors or investors with a lot of deep pocket. So clearly it seems like the sentiment may be turning around for the stock, given that the sort of correction that we have seen. A lot of people are of the opinion that valuations have now, Santo, become reasonable. I don't think that the argument that valuations are pricier or expensive can hold stead going ahead for Nazara. Apart from that, you could see the sentiment also remaining a little bullish going ahead, because finally the company has announced the record date for the bonus issue, which will be around June 27th. So there could be some sort of short-term buying for people who want to be participating in that bonus issue of the company. And if you look at the fundamental side, well, clearly this is still the best way to play the Indian gaming market, which is a fast-growing market, up-and-coming market. It has been a niche market. It's a very nascent market in India compared to maybe US and Europe. But clearly, a lot of people, if you talk to a lot of industry experts, they feel that this is one market that is going to go leaps and bounds, especially in the wake of the uptake it has seen during the pandemic. So I think the fundamentals still look quite good, Santo, and the valuations definitely look quite attractive now.
Well, CJ, now the stock is entering a slightly dangerous territory. It has now slipped below its issue price, and that I think could lead to further pressure on the stock in the short term.
I doubt.
It had rallied quite well till some months back, but now I think it's losing its charm. That's one part. The second thing is that the numbers, the operating profit, the growth, if you see over the last few years, the growth has been very, it's been inconsistent. Probably now you might say that this is a technology company, that's the way, these things work. Also, the company is in seems to be in an investment phase right now, which is why you're seeing very less operating actual EBITDA there. This, besides that, given that the company is an investing phase, would you pay this kind of very hefty valuations, which is almost 120 times?
That is what I don't think the valuations are that hefty. I mean, come on, if people were this is the entire thing about psyche, right? When the stock was at 52-week high, a lot of people were like, the valuation is justified. Clearly, if you look at the growth dynamics and all that. Now, the growth dynamics have not really altered. It's just that the valuations have corrected in line with the sort of correction that we have been seeing in technology names across the board, across the world, right? So for me, if the growth trajectory is still there, if the outlook is still justified, a 70% drawdown in the stock should really, make you probably licking your fingers if you're a long-term investor.
The valuations which were being paid till some months back, they were quite obscene. Relative to that, probably they would have moderated a bit, but well, I'm not so convinced about this one. HDFC AMC, however, is a stock probably one should have a look at. Now, again, CJ, I could never understand this, that despite a lot of money flowing into a mutual fund through SIPs and even direct investments. The same was not being reflected in the performance of AMC.
Yeah, that is because HDFC AMC is not getting a lot of it, Santo. That is why.
So, okay, so this is the, if you look at it, CJ, over the last few days, I think now brokering houses are beginning to look for stories where they feel the valuations can be said to be reasonable. That's why you had CLSA coming out with a buy recommendation on Nippon, saying that the worst was already reflecting in the price, and Kotak Institutional Equity seems to have a somewhat similar view on HDFC AMC. So, couple of things which it has pointed out is that a main reason for the underperformance of HDFC AMC was that its major equity schemes were not doing well. It was losing market share, but now there is an improvement in that. 70% of its equity AUM is now either in the first or second quartile. So, definite improvement there. Also, HDFC AMC was paying high commission to distributors, and also you had to do that because there were a lot of NFOs at that time. Now, that has moderated. Probably HDFC AMC can now get away with paying little less than what it used to do earlier. These are a couple of factors which seem to be in favor of the stock at this point, and Kotak sees around 1975 as a fair value for this stock. The stock is quoting well below that. It's taken quite a bit of beating, and I think this could be a stock to keep an eye out for.
Well, Santo, I'll tell you why HDFC was probably outperforming the past 1 year is because they had loaded up on PSU stocks, and that was one of the reasons why they were underperforming the market as well during that entire 2019-2020 phase. Now, let's not forget that the cycle is again turning against PSU stocks. You have seen what has happened to commodity stocks over the past 1 month. You're seeing a lot of other PSU names also taking a beating. Now, I am a little skeptical whether this outperformance on the equity scheme side will continue for HDFC given its high exposure to a lot of PSU names out there. So that is one part. You talk about the AUM growth, Santo. Yes, maybe the market share will improve going ahead. Clearly, this company has lost a lot of market share over the past 3 to 4 years. Maybe that improves. But if you look at still at the aggregate AUM growth that Kotak is expecting, it's still quite shallow at around 13%. Now that in a country like India, where the story that always gets peddled around is that under penetration story, that there is still a lot of room to go for equity AUMs to grow for mutual fund industry, I think 13% is just not exciting enough for me when you talk about the AUM. Apart from that, we are entering a very volatile. We have already entered a very volatile phase in the stock market, and in this sort of phase, you would generally expect that equity inflows could start moderating going ahead as 1 year returns, 2 year returns start turning negative for a lot of equity mutual fund schemes. Apart from that, the rising share of passive funds, this is one argument that I talked about in the case of Nippon as well. The rising share of passive funds could also hurt profitability going ahead, because let's not forget that the mutual fund industry is gearing up for a lot of incoming competition from guys like Zerodha, Navi Mutual Fund, who are trying to focus just solely on passive fund going ahead. So clearly that also remains a risk as far as margins are concerned, even though the distribution commission side could improve in the near term. So for me, I think HDFC still remains one stock that I would rather steer clear of, because the growth prospects are just not exciting enough for me.
One short point here, I think this whole rush towards passive funds, probably that could be peaking out, at least for the time being, because...
You think so?
I think so, because everyone seems to feel that this is a sure shot way to generate easy money, and you saw active funds struggle because of that. But now I think when the market as a whole probably is likely to stay range bound, now we are talking about entering a bear market. That simple thing of just going and putting money into a passive fund won't work typically when the indices usually tend to move down. So at such a juncture, I think once again it will be the active funds which will outperform. So probably you could see some shift.
Well, Santo, one stock that is clearly likely to outperform going ahead is Deepak Nitrite, and the stock has risen today along with a lot of other chemical names on the back of a little bit of short covering that has happened on the counter, but also because the earnings outlook also seems like a little positive. It seems a lot of analysts are now of the opinion that some of the negatives around the company vis-a-vis the margin compression that they had seen in the first 4 or 5 months of the year, that probably is now behind. You are seeing that a lot of commodity prices, raw material prices are coming down from their peak in March. So clearly there is a tailwind when you look at the margin side of the story. Apart from that, if you look at the demand side, IFL Securities is of the opinion that demand for acetone and phenol, two major products that Deepak Nitrite makes, have been quite strong and have remained quite strong over the past 2 to 3 months. So that clearly the demand tailwind remains, Santo, and if the raw material prices stabilize or maybe soften from here on, clearly that margin uptick will also come, which was the only main concern that the market had. Apart from that, market was largely happy about, Deepak Nitrite's demand story, the entire China Plus One story that everybody has been talking about for the past 2 years. So clearly, a lot of things are now starting to looking up for Deepak Nitrite after the sort of meaningful correction that we have seen in the stock of more than 20 to 25%.
Well, CJ, I'm not arguing about the fundamental side of the story here. That's already reflecting in the numbers for FY22, and you saw some really good numbers for the fourth quarter as well. Now, what's caught my attention is that despite that, the stock has started to underperform right from Jan. In fact, it peaked sometime around November. Already, it's come off quite sharply from its high. It's close to about 40% high from its peak. This, even as its operating performance was improving.
Exactly.
You're seeing institutional investors steadily paring stake exposure to the company over the last 3 quarters. The stake has come down by about 500 basis points. And again, look at yesterday's crash, 7%, and today the mid-cap index is among the biggest gainers. Most stocks are rallying. But if you look at the bounce back in Deepak Nitrite, it's been barely about 1% up, whereas the stocks which had fallen 6-7% yesterday are all back up 6%. You're seeing heavy short covering there, but in the case of Deepak Nitrite, the stock tried to make a comeback, but has not been able to sustain at higher levels, indicating that there is some kind of selling pressure there. The blast at its Vadodara facility, that has dampened sentiment. While the company had said that that's not major problem and they'll be able to come back very quickly, but now there's the Gujarat Pollution Board has asked the company to shut down the plant till it completely checks and then certifies it. So these are some of the negatives. And lastly, CJ, the company has lined up about 1,500 crore of expansion in greenfield. It has already cleared. It's got a board approval for 2,000 crore QIP, which means that more shares coming into the system. Probably that is something, this equity dilution is something the market seems to be worried about, which is why you're seeing an underperformance in the stock.
Santo, I take your point, in the near term, maybe a lot of these sentimental factors could be an issue. And sometimes, in the market, the sentiments can run too ahead of, on either side. It can run ahead on the negative side, it can run ahead on the positive side. In this case, I just believe that market is becoming too bearish for a company whose operating level performance has remained quite steady, even in an environment as uncertain and volatile as the global environment is right now. I think this is one of those spaces where the longer term picture still remains largely intact. I mean, you cannot change the fact that a lot of multinational companies are looking for an alternative for their Chinese suppliers. You cannot change that fact. That is a fact that is happening, unveiling itself right now as we speak. So clearly the long-term tailwinds remain, and maybe the near-term sentiment factors could affect the stock price in the near term, but this could be a good opportunity for those who want to play the longer picture.
Well, the last stock on our watch list this afternoon is Larsen & Toubro. Now in Nomura's note, the broking house has said that the company has indicated that it's seeing good demand on the private sector capex side as well, and it sees a meaningful recovery in the second half of this year. Also, the company has said that the guidance was about 10 to 12%, which was much lower than what the market was expecting. But there's a reason for it. Is that the company said it's already the order book is quite strong, and it will be selective about the orders it will bid for, and it would go in for only the really large orders which are profitable. Nomura has a buy target on the stock with a fair value of 1,995.
Santo, I don't, I will take that comment about the private sector capex recovery with a pinch of salt. I mean, and I think IFL also agrees with me. They also came out in their report and said today that I think in the capital goods side of the industry, is becoming too optimistic about recovering private capex. They believe that there will be definitely a delay in the recovery of capex on the private sector side, clearly because at this point of time the macro environments are just not suitable for companies to go out there and write out big checks. You don't know where the demand is at this point of time. We clearly know that domestic demand has still not recovered from the pandemic lows, right? So there are clearly a lot of uncertainties out there for corporates to probably delay any expansion plans that they have going ahead. And some of the sectors that actually were trying to get into, jump into that ship now have been knocked down because of certain measures that the government has taken to control inflation. So clearly, private capex is one, narrative that has been, kept on the back burner for me at this point of time, and some of the brokerages out there also agree to it. Apart from that, L&T also gets affected by higher crude oil prices, right? The management itself said that higher crude oil prices could force the government to trim down on infrastructure spending in the budget or in the current financial year. So that is one concern that also remains on the stock. And lastly, banks have also, they have remained quite tight-lipped about core capex in the corporate sector. They have said that corporate balance sheets are good, they are healthy, but beyond that, they have not really talked about, very strong upswing in corporate loan going ahead. So clearly, I would, be a little skeptical about L&T achieving that 12 to 15% of, growth target that they have for their order inflows in FY23. This will be one stock, yes, from an outside, it looks like it's a good story, but maybe if you dig a little deeper, maybe this is one story that you would probably want to pause at this point of time.
Well,
I think we should take a quick check on the market, Santo. Clearly, it looks like we are headed for a very, very strong close at this juncture. Yeah, I mean, Nifty, Sensex and Nifty have come off a little bit from the highs of the day. They are now trading about 1.9% higher. When we started the session, we were about 2.2% higher, but it's the Nifty mid-cap which is really taking its own now, higher by about 3.7%, Santo. So clearly a lot of the selling yesterday has been made up in just one day.
It has been made, but as we spoke about in the show earlier, CJ, I think this is a relief rally and it should be used to trim exposure to some of the stocks which may have seen its best already.
Well, if we see another 2% move tomorrow, Santo, you will be looking
quite
I will
not
strange one out there. Anyway, that said, what Gyan do you have for us in our next segment?
Oh, Gyan. Okay, so here is this interesting thing about the Japanese yen. It's been making, steadily making new lows against the dollar.
Yeah.
It's right now almost at a 24-year low. Now,
24 years?
Yes. Wow. Now, the thing about Japanese interest rates is that it's been out of whack with the rest of the world. That's because the central bank, that's the Bank of Japan, which is its central bank, has decided to keep interest rates, persist with its policy of ultra low interest rates. Now, that does not seem to be helping anybody, especially it used to work well at a time, when Japan was the major exporter. Now, in fact, most Japanese companies have set up plants abroad, which is not the...
I mean, India has been one of the beneficiaries of
that, that's true. Besides that, when prices are rising, especially fuel, food grains and other things, it hurts households in Japan as well. So, to curb inflation at some point, maybe the Japanese central bank will have to consider raising interest rate. And in fact, that is what most hedge funds seem to be banking on. They are almost betting that at some point, the Japanese government will have to bite the bullet and raise interest rates.
So how will it affect somebody like me sitting here? I mean, why would I care about BOJ raising interest rates or not?
That's because, CJ, when interest rates in Japan are very low, what most fund houses do is that they borrow in Japanese yen, convert it into dollars and invest it in other asset classes.
And because they would get more returns.
Yes, and because the cost of funding is very low, right? You borrow in yen, convert it into dollars, invest in either commodities or equities, emerging market equities, make huge returns, and then repay whatever you have borrowed. Now, that has been going on for a fairly long time. You saw this in 2008 when the Japanese yen appreciated and all of a sudden there was mayhem, because then the cost of borrowing for these funds go up significantly, and if at a time when other asset classes are not performing well, it means that their returns would be further squeezed. So, this is, I think, something that we need to be cautious about.
Well, Santo, that really sounds like an alarm. You're ringing the alarm bells there. But I would just have 2 points to say. One is, I don't think we should take the BOJ so lightly. I mean, if there is a central bank out there which can hold its own after the Fed, it's probably the Bank of Japan. I mean, you would not even count the European Central Bank in terms of being able to hold its own fort the way the Bank of Japan has been doing it. I mean, it has gone through crisis after crisis and still its policy has largely remained
just like I think
accommodative.
people writing the obituary of the dollar.
Yeah, exactly. I mean, so it's central banking policy has remained accommodative for a good part of 30 years now. So clearly, I would not want to fight the Fed, the BOJ head on as the hedge funds are doing. And apart from that, if you look at, if we were probably at the highs, globally in terms of the stock market, if you talk about emerging market equities, and probably we had these carry trades being unwinded, I would have been more concerned. But we have already seen a meaningful correction in global stock market, even in the commodity markets. If you talk about the last few weeks, we have seen a meaningful correction there. So I don't know how much scope there is for a lot of these carry trades to be unwound. And if they do start getting unwinded, probably they will start happening when the rest of the market, global markets, are probably on a recovery trajectory, and maybe that will make the entire process much more smoother than making probably everybody more panicky.
Well, short point here again, CJ, just some lessons from history. In 2008, it was, somewhat similar was the view, because the market had corrected significantly from Jan of 2008 till about, September, or it had already fallen a fair bit. So that was the general feeling that, even if, let's say, the yen were to appreciate, most of the carry trades have already been unwound, but you saw really massive selling in October of 2008.
Yeah, because of course the Lehman Brothers went out there and chose to collapse.
Yeah, so it is not as if the entire carry trade would have been unwound. It can still make its impact if in case the Japanese yen does appreciate.
Well, that's it on ICY-MI today. All the gyan from Santo, from history from 2008 to 2002, Santo has seen it all. Clearly, Santo, we should wrap up the show then?
Yes, well, with that, it's a wrap. Thank you for watching, and do let us know about your comments in the feedback section below.
And do follow us on the social media links at the bottom of your screen. And for rest of your financial news, stay tuned to moneycontrol.com and the Moneycontrol app. We'll catch you again live tomorrow 9 a.m.